And for PayPal, my price prediction is PayPal just announced earnings and the stock is down 6% even though the company performed relatively well. So what in the world is going on and how does this affect the future stock price of the company? After weeks of hard research, I'm gonna present you with my price prediction as well as the things that you need to keep in mind if you're looking to invest in PayPal stock. Okay, so as you can see, PayPal just released their Q3 earnings, and the main negative thing that happened is that the revenue fell short of the expectations. However, for the most part, all other important metrics did better. So let me just show you. So right here, it says the revenue growth was 6% year over year, which is great. So this led to a number of 7.85 billion, but the analyst estimates were saying that the revenue should have been 7.88 billion. So there's a small difference between the numbers, and this is why the stock is currently down at the time that I'm recording this video. However, the one thing that was really good is that the company reported an EPS of 120, and this beat the consensus of the analysts that were expecting a number of 1.07. Now, there's a whole bunch of other metrics that are important to consider that went up over this quarter. So the total payment volumes, total active accounts, operating margins, operating cash flow, and overall, it seems that the company had a great quarter with the exception of the revenues, which is obviously a big driver of growth in the stock price, and it's something that we will take into account for our price prediction. Now, when it comes to the stock price itself, you can see the change over the past 5 days. So as you can see, it's a minor change right here, and then here it's been a positive change. 6 months has been a positive change. Year to date, it's been a great stock, and this is why a lot of people are now starting to consider investing in PayPal. 1 year, the performance has been excellent, and there's been a key driver in this particular time period right here. What I didn't show you from that report is that there was a new CEO change for the company, and that CEO change happened 1 year ago. So really, I mean, correlation does not equal causation, but the CEO has done an amazing job, and this is why the stock price has reflected those improvements. But the problem and the downside is that the stock has done terribly over the last 5 years. This is something we need to take into account, and some of the reasons why just were the decrease in the margins, the increase in the competitive strength from other players in the space, and those are some of the things that we're also going to address in this analysis. So when it comes to the payments global market, you can see the market share right here, and as you can see, PayPal has the strongest numbers out of everybody by far, 46% of the market. That is absolutely huge. And as you can see, the other competitors, they have smaller percentages. Braintree, I believe, is also owned by PayPal, so this is really something that belongs to them. The real competitor right here is Stripe, in my opinion. And the reason why is because they're such a formidable threat. Now, the only thing when it comes to Stripe is that they're more focused on the merchant side, meaning like companies that are like SaaS or that want to have and build custom payment systems. That's when Stripe becomes really powerful. But for the most part, the largest part of the market belongs to PayPal. And PayPal not only has Braintree, but they also have Venmo. So as you can see right now, when it comes to the market share of these different cash apps that are available, Venmo has the largest share, and this is something that's becoming more and more popular in the United States, but also all across the world. So the company is very well positioned for this. The concern about the market share decreasing was the fact that the company was becoming less and less innovative over time, and this was allowing some of these players right here to get more and more market share. But now the company has really shaken things up, and I'm gonna walk you through that as well. So we talked about the change of the CEO, we talked about the lack of innovation as some of the problems or some of the catalysts of PayPal stock growth. So as you can see right now, we're looking at a video from 9 months ago, and this was an interview that they did with the CEO, Alex Chris. And in this interview, he famously said, "We will shock the world." And what he was referring to in this interview is the new wave of innovation that he was going to bring to the company. First, he was very successful as one of the top executives in it, which is one of the hottest stocks for the last 5 years. years, and now he's trying to do the same with PayPal. After this announcement that he will shock the world, he went ahead and delivered a new keynote where he explained the different innovations that are going to take place in PayPal. I recommend that you watch it, but it's going to walk you through the innovations that they're trying to implement so that they increase conversion rates for the merchants and that they make payments easier for the consumers, because those are the two main segments of their business, and those changes are already starting to pay off in the results that we saw for this quarter. Now, when it comes to the market itself, PayPal is in an absolutely fantastic market. And as you can see right now, based on the forecast, this market is expected to grow at a CAGR of 14.5%. So there's a ton of room for growth for this particular company. PayPal, as we saw before, is one of the leaders in this space. So they're very well positioned, especially with the new innovations, new CEO, new execution, to be able to take advantage of this growth in the market. A lot of that growth is also happening in the US, where PayPal is extremely well positioned to capture a large percentage of it. And that is because of their different offerings such as Venmo, Braintree, as well as PayPal itself. And I think with the new innovations that they're bringing into the marketplace, they're just going to make it more and more difficult for these different competitors to be able to compete and be successful. The other very smart thing that the company has done is partner with the giants of commerce online. So there's two key partnerships that I want to mention, but there's been a lot of different partnerships that the company has focused on. In this case, the number one partnership that you can see is with Amazon Prime. And this is because PayPal is now a checkout option, which you can imagine how much revenue, how much growth that can bring to the company. And then the second one is with the e-commerce giant Shopify. And the reason why is because the company is so well positioned when it comes to e-commerce. And with this new partnership, PayPal is able to get a whole bunch of new transactions just from the existing huge network of merchants that have stores with Shopify and that they're managed all of their different operations and sales through this different software. To analyze the company's health, I'm going to be using Y-Sheets. So if you use the Y-Sheets add-on, you can just type PayPal right here. We can see the stock, and we're going to look at the annual financials. Click on get data to get all of the different data. And what we can see right away is, first, there's something weird going on. And that is the fact that the company's net income is kind of jumping all over the place. So for example, if I calculate the percentage change from this year to this previous year, you're going to be able to see what I'm talking about. So you can see in this case 76%, which is massive, and part of what the CEO said that they were trying to do, which is to generate more profitable growth. And you can see the weirdness right here, that it just kind of goes all over the place. I think in the past the company focused too much on the acquisitions and it kind of forgot about its main strength, which is its current PayPal product. When it comes to the revenue growth, we can see that the number is a lot more consistent. So right now it's been about 8%, which is not ideal because the market is growing faster than this, but just something to consider. Now, one thing is that margins are also seeming to improve. So as you can see, especially in the last year, there's been a good improvement, as well as the net income ratio, which is just a result of the net income also increasing as well. The company doesn't have too much debt, so that is an area that locally we don't have to worry too much about, and they do have a good amount of current assets to cover the current liabilities. And the stockholders' equity is increasing year over year, although not as much as we would ideally want to see. Free cash flow hasn't grown much, unfortunately, but I do think that is a product of the acquisitions that have been made by the company in the past. However, the patterns of the company when it comes to how it's using its cash flows seem pretty healthy. Now, when it comes to the price prediction, here's some of the data that we're analyzing. So first, I have Y-Sheets right here, and you can easily build a model like this using this formula where it says, I want to get the data for PayPal, I want to get this data, and I want to get it for these different periods. If I click enter, you can see that everything is going to automatically refresh, and this is going to generate these graphs that I just set up right here. And the same is being done, but on a quarterly basis, so we can analyze the historical data that we need for the price prediction. As we can see, when it comes to the PE ratio on an annual basis, it's usually been about 18, 15, 33, 53, 63. So it's been all over the place. I think a more fair number would be actually what it is right now, somewhere around 18, maybe 15, maybe 19. You can even say 20 realistically, because the company's in a high growth market. Now, the company has to perform really well for that to be the case. And the other thing that I like to look at is the relationship between the revenue and the market cap. And as you can see, the revenue has been steadily increasing, more so now than before. And the market cap is just kind of all over the place. But now the market cap is kind of going down, even though the revenue is increasing significantly. So I think what we're gonna see is that the market cap is gonna start to climb back up as well. But again, this only works if we're paying the right price for this particular stock. Now, the other way in which we can look at this is from a price to sales ratio. And this is because the company is a SaaS company, and companies of this kind, usually when they're about to be sold, this is one of the ways, or one of the simple ways in which they're sold. So if we look at the price to sales ratio, and this is quarterly, so we just have to divide it by 4, you can see what it is on a quarterly basis. So usually 1.9, 2, 2.5, 2.15, 3, 3, 5, 10, 9. I mean, there's been numbers all over the place just because of the hype of the stock. But I think a reasonable number would be like 2.5, maybe like 3 in terms of a price to sales ratio. And we can also look at the PE ratio on this lens. So putting everything together into our model, we have 2 different scenarios that I foresee happening, and each scenario has a different stock price. The first scenario is based on a PE ratio basis. So in this case, we forecast the revenue growth to be about 8%. I think eventually you could maybe average like a 10 or 9%. So if you want, you can change it to 9%. Terminal PE, I think 15 is a good number. You can also raise it a little bit, maybe 17. This is a little lower than what we have right now, which is an 18. And then as you can see, we have the revenue on a TTM basis is projected for all these different years. And then we have the net income percentage that we project. So these projections right here are based on the improvements and the innovations that are taking place for the company that are allowing the net margins to be better. So I would expect that right now this margin is going to be fairly steady until this year's, where it kind of increases a little bit more using a discount of 15%, which is pretty reasonable given the current situation. I mean, you could also lower it to 12% realistically, but I'm going to keep it at 15%. We get a value of $63 per share. Right now, the price using this formula for Y sheets, you can see that it is at $80.17. So this represents a downside of negative 21%. If I refresh this, you can see the different scenarios in which the investment becomes profitable. So if revenue growth is about between 15 to 25%, and the PE ratio is between 15 to 20. This is the only scenario where the investment becomes profitable, and you can see what that would lead to in terms of a CAGR. Now, the other scenario is the price to sales ratio. So in this scenario, again, we can go with the 8%. We can go with a terminal price to sales ratio of 3. This becomes a lot more easy to forecast. We have our numbers right here, and then what we do is we do our forecast for the future years, and then what we do is just multiply the sales in 2029 times the price to sales ratio. This is what the company would sell for on this hypothetical scenario. And as you can see, we still have our 15%, but this gives us a slightly different value depending on how we adjust it. So around $66 per share. Price is 81. Well, this needs to be updated because it's the same as before, so 80. You can see this is a downside of 17%, so slight price difference. And we can also model the different scenarios in which this makes sense. So this is based on the revenue growth, which is pretty good, and then also the price to sales. I think in this case I would like to have it on a 1 basis, so I would like to have maybe like 1, 2, 3, 4 perhaps. I think that might be a little bit more realistic, but this is just an analysis that you can do on your own. So therefore the price prediction is about $66 per share. At this particular price, I would not recommend buying PayPal stock unless you foresee more growth but I would highly recommend that you keep an eye on the stock, because this is one of the stocks that I think is going to do really well as the company keeps executing better and better over the long term. So I recommend that you keep it on your watch list, and if the stock for any reason hits like a price close to like $65 per share, that's when I would personally jump on it. If you've enjoyed this video, make sure to subscribe to the channel, turn on the notifications on, and I'll see you in the next one.